I think the noise effect, the panic effect could occur that quickly. So if silver does and gold accelerates from here, and even if gold just went to its normal, a full move, go to 8,000, people would be pulling their hair out. And yet it's done it before. What are you crazy about? Yeah, when you look at an arithmetic price chart and you run RSI or something, you think, oh my gosh, it's got to be over. It hasn't even begun, especially if one, you break the silver gold spread out. Yeah, no, I think you're going to see a major asset class movement favoring the monetary metals, especially silver. Now, I think the silver catch-up to gold could occur in a matter of a couple quarters. That doesn't mean it's over at that point, by the way. Because, again, I think during that period of time, if silver's accelerating versus gold, and also if that first chart we looked at when gold is breaking out versus the S&P, many events are going to occur in headline form that have nothing to do directly with gold or S&P, but have to do with macroeconomic trend, breakdown in certain institutions, panic among the public. I mean, think about it. If you're just an average Joe out there, you've only got one thing in your financial horizon, your personal financial horizon, that you can smile about. That is, if you have a portfolio of stocks in your retirement account that is front-end loaded with AI stocks, okay? You can smile. You can say, oh, I'm up 10% on the year, or 15%. Most market indexes aren't, but okay. That's the only thing you're smiling about. Meanwhile, gold's up over 50%, silver's up over 60, 70% on the year. But if you take that away from the average guy, who he doesn't even have that to smile about, he's already being pinched by cost of living. And what if his wife loses her job, because maybe they both work to survive, and maybe they're late on their mortgage payment, and we all know that credit card delinquencies are through the roof. Credit card use is up to max levels in many cases, more than ever. So all of these things can go wrong in the real world and change the nature of your view of reality. What's best? In fact, if you go to the very last page of this report, we have a very interesting chart. And this is just a little tap on the shoulder. The chart at the top is the Bloomberg Commodity Index. It's a price chart, monthly. It goes back to 2020, when it made its all-time low. You had that explosion that more or less doubled the price of the Bloomberg. But even when it got up to 140, it was still, the high in 2008 was 238. Okay? And right now, over the last couple of years, you can see Bloomberg's going sideways, Bloomberg Commodity Index, which is a well-balanced index with agricultural, base metals, energy, etc. It's been dead quiet either side of 100. Now it's broken out. The October close to us was a breakout saying, I'm awake again. Okay, but now the really important chart is not that commodities are about to go up again from very cheap levels. Again, 238 was the price level in 2008, and right now we're 107.8. Long way to go. We're not even halfway there, okay? Scroll to the very bottom chart. Yeah, that one. Blow it up if you can. Here we go back to 2000. And you'll see that the Bloomberg was gaining in value versus the S&P 500 from 2000 to 2008, okay? It went from like 7% value, divide Bloomberg price into S&P price. 7% of the S&P up to 18, that's more than a double in relative value. Commodities were the place to be, okay? Even during the 2000 to 2002 bear market in stocks, Bloomberg was going up relative to stocks. Okay, and during a lot of the bear market, 2007 to 9, Bloomberg was still going up. Now, finally, it reached a level where it peaked in price. That's that 238 price level I mentioned. Its performance peaked at 18%. And then you blew through a floor, the red line floor, at about 11%. That was in 2012, and really collapsed. Bloomberg got down to 2% of the price of the S&P. I mean, it's like, who needs commodity assets anymore? We don't need the real world. We're living on paper. Okay, fine. It really ceased to go down in about 2020. And we had that rally in 2022 when Bloomberg doubled in price from 50 to 140, mid-50s to 140. The spread also upticked. But then it came down and sagged through those lows slightly in 2024 and has gone up and bumped that 2% level from underneath. If you ever get the Bloomberg back up above that 2% level, it's not a big event to do that. It's saying, okay, I'm coming up out of here. And if you ever get up above that 3+% level, the base is completed. And we're arguing that there is going to be a global perception and investor preference shift over a prolonged period of time now. We're not talking a 6-month rally here. In favor of real world assets and stocks that are related to those real world assets out of what we call the stock market now, which is largely, front end loaded AI and so forth. So if this turns up, and I suspect on the coattails of gold, it's likely to, especially since October close on those top charts was a breakout for us. I think this spread's probably going to turn up too. You get a little weakness in the S&P and a little upticks further in the Bloomberg, that spread's going to start to move. And when it does, you have an open void above you, thin air, before you can even find next resistance. And what that means is it's probably a good idea from an investment long-term, 10-year point of view. Where should I put my money over the next decade? Well, already Bloomberg, if you uptick over that 2% level, is telling you, I've not really been a bad place to be for the last 4 or 5 years. I was at 2% 4 years ago. If I'm still at 2%, for example, hey, I've really matched the value of the S&P. I've gone flat, okay? But you resurrect the spread, and it's saying it's time to look at the whole nother part of the world. That's which is under your feet. And, what does that mean? It may mean, you break the stock market and it creates emotion. People say, well, what the heck should I be in? At least you can pick it up and touch it, okay? And we're arguing, don't be surprised if over the next decade, this is a good place to basically be from an investment point of view.
For many families, the economy already feels broken. Paychecks are stretched, inflation persists, and dual-income households are struggling just to keep up. Credit card usage has hit record highs, delinquencies are climbing, and layoffs are rising across tech, retail, and manufacturing. Even if stocks rise on paper, most households feel poorer. When job security weakens and the cost of living crushes budgets, people search for safer stores of value. If equities crack, the last remaining smile in the average retirement account could disappear overnight, pushing millions to rediscover assets you can physically hold and trust.
Well, it has trended down. And I think it's about to base. It's saying, I've quit going down effectively in late 2020, early 2020, excuse me, and it really hasn't gone down that much since then. So it's really, if you'd bought the Bloomberg or bought a basket of commodities or commodity-related stocks back in 2020, you're not doing all that much less good than the S&P, okay? And if you resurrect yourself up into this base again, 2% plus, it's the first signal, the next one's over that 3, then the game's on. And I think this guy is saying to us, given what's happened since the last 5 years, I'm just not going a lot lower. What do you want me to do, go to zero? Okay? So, this is one of these situations, your father told you buy low, sell high, or your granddad did. Okay. This is a situation where it's a buy low situation, and we're not far away from rendering the signal that says it's time. And I think that could be related to two certain things that go on. One, a breakage in the stock market bubbles, especially the U.S. bubble, which is the biggest in the world right now, in terms of duration and multiple gain since 2009 low, and a resurrection and an increase in inflation, because you know what the central banks will do when their stock markets start to create pain. They're going to have to print. Plus their own government debt markets you have to print to save them. They have no choice. And if they revert to that direction again, which they're already doing, it's an ongoing process with central banks. They always decay their money units. The question is, do they accelerate it? You break the stock market, that will accelerate that situation and will create money flow. And if it's not going into stocks, where will it go? Stocks related to commodities and commodities themselves. And we're seeing that. I mean, copper, for example, crude oil is $61 or so right now. You get up to 68 anytime during this quarter, you don't want to close a month there, because if you do, it's going to take off. That's a major breakout for oil by our metrics. And various other commodities are rendering similar technical signals in sync with what the Bloomberg did in October. So it's time to wake up and think about a different horizon from a long-term perspective.
The Bloomberg Commodity Index, tracking energy, metals, and agriculture, has spent years stuck in a quiet sideways pattern. But recent breakouts signal renewed momentum toward higher real asset pricing. Despite doubling from pandemic lows, the index is still far below its 2008 peak. Historically, commodities outperform stocks during inflationary stress, and today's setup resembles the powerful run from 2000-2008. A decisive rise in commodities versus the S&P 500 would confirm a new trend. Investors favoring resources that fuel the real economy over speculative growth stories. The groundwork is forming for a decade-long shift in capital flows.
Because back in the 2000 to 2020 to 22 rally, which by the way peaked weeks after the war began in Ukraine, that didn't take it up. That's what peaked it really, and then you pull back. That was a pretty good mix of most commodities joining in on that. Energy tended to lead in percent gain basis, but grains gained a lot, copper gained a lot. It was a pretty broad basket. And even now, recently, platinum, which has been dead as a dog for a decade, has suddenly said, I'm awake again, in correlation with the movement in the Bloomberg, okay? Not with gold. Its correlation to gold is not good at all. But even platinum is back in the game. So, no, what we see, we examine all the major commodity categories each month and the Bloomberg in a monthly report. And we can see in almost every single subset of the Bloomberg similar technical signals that indicate this sector is going up. Grains, oil's going up. Natural gas, for example, has resurrected itself. Platinum has suddenly come out of the hole. Palladium too. Base metals in general. So we see it as a basket situation, and I think it is not due to the specific fundamentals necessarily in each of those commodities, but in a broader movement of money into a broad asset category that is vastly undervalued relative to the paper assets.
If commodities rise above key long-term thresholds, it could trigger a stampede into tangible assets. Central banks, already fighting rising debt costs and recession risk, will likely return to money printing to prevent market collapses. But printing dilutes currency, pushing more investors toward metals and resource-backed industries. This isn't about a 6-month rally. It's a structural rotation, potentially similar to the last commodity supercycle, where holders of physical wealth prosper while paper assets stagnate. The stock market bubble, especially in the U.S., may soon collide with economic reality.
Well, again, this time around, well, first off, silver. Let's talk about just silver itself. We've run studies showing the confinement that silver's been in for 50 years. $50 high in 1980, near 50 in 2011. Traded above 50 briefly, now trading around 48, 49. Okay, we think that not just price nipped out the high, and the problem there was you had an explosion just to get up and take it out. For example, you went up like 11 weeks in a row in silver, higher highs, higher lows, higher highs, higher lows, doubled, like 50% increase in price almost. Okay, 40%, matter of a few handful of weeks. So it needed to pull back. Fine. Okay. And you sucked in a bunch of longs who bought when it broke through 50. That's an idiot number. Yeah, it's significant. But it's when you real dollar value silver, go back to 1980 and try to convert $50 silver then to where it should be now, it'd be like $200 or something. Okay. Something similar when the 2011 high. So they're ridiculous measure points to reference. Okay. But when that spread breaks out, it's telling us we're going up. Okay, silver's going to beat gold. Now, what about the issue of, well, once they peak, won't they collapse again? Yeah, you'll probably reach a level where silver will drop very sharply. But again, it's going to be in a new reality. It's not coming back to $30 or $40 or $50. If you go to 200, yeah, you might have a $50 sell-off or something, but you're going into a new price reality. We ran charts, for example, going back into the late 70s, early 80s on copper and on lead. Exciting metal, okay. They lived in a range, the 70s, 80s, 90s, and into like 2005 and 6. So multi-decade range, where they lived in a rectangular range, price range, just like silver's been in for 50 years. But when they came up out of that range, and for copper it was like mid-2005 into 2006, in a matter of a couple quarters, copper price quadrupled. Quadrupled. Yeah, it had a sharp sell-off after that, but then it leveled off into a range of action since 2007, that if you cut through the middle of the range, it's about 4 times the middle of the range that prevailed from the 70s, 80s, 90s into 2000. So it quadrupled and then went into a new reality. Same with lead. Different time. It occurred in 2007. It like quadrupled in a couple quarters into a new reality, had a sell-off, but then leveled off into a reality that was like quadruple the average price of that multi-decade range, 70s, 80s, 90s, 2000. Okay. Silver hasn't done that. Why? Well, there's various valid notions out there why it might be. One has been manipulated and attempted to be contained by banks, possibly working in conjunction with central banks, et cetera, et cetera. And we know to some extent that is true because there have been actually convictions in that regard. But when silver gets out of the old reality, they don't do it incrementally. And this is not just true with copper and lead, by the way. We could have shown many other charts of different assets, commodity assets. When you go into a new reality, you do it quickly. You say, oops, I've made a mistake. I shouldn't have been in that same range for 50 years. I'm out of here. And when it comes out of there, all notions of norms, like overbought, RSI will be off the page. Probably stay there for 6 months. You better be long during overbought RSI. You get my point? And it'll go to a new reality. Now, we think also that once we get into that new reality, it's not merely a norm. Things are going to change in the world in financial assets, stock market breakage, sense of doubt about the validity of a government monopoly over the money unit. That's like, it's a socialist concept that the government should control an essential commodity and price it arbitrarily. Well, money is an essential commodity asset. It's the interchange between you and me if we buy and sell something. If I buy something from somebody who manufactured it in China or Europe, I don't meet them personally, but I exchange a money unit with them. And those money units are constantly decaying because the governments manipulate them for their own essential survival purposes to support government. But it's a distortion. They have a monopoly over the quantity of money and the pricing of money, interest rates. Does that make sense? If all of a sudden that concept gets into doubt, and there are already people talking about, hey, this Fed system, it's only been around 100 years, hasn't really worked. We've had boom-bust monetary policies with boom-bust stock markets. Is it really working? Or has it been in process of ongoing decay in people's money units? Those kind of questions could arise, or are likely to arise in this next phase of what's going on here. And it's being expressed already, I think, by gold and silver.
Silver has been trapped in the same price zone for nearly 50 years, a range that historically precedes violent breakouts. When compared to inflation, silver's prior peaks would be equivalent to 200 plus per ounce today. Other metals like copper and lead experienced similar decades-long consolidations, then quadrupled within a few quarters once they escaped. Silver may follow that template. Its dual role as both money and an essential industrial metal, powering solar, batteries, and electronics, gives it unique upside. When silver breaks free, traditional overbought rules vanish, and a new price reality emerges.
It will speed up, just like we argue that silver is likely to go to a new reality and do so quickly. And that's my main focus right now. It's not the next 10 years, but the next 6 months, especially when you break that spread out. When that occurs, other things will be occurring too. It won't just be gold and silver going up. It's likely to be the stock market going down. It's likely to be the real world in the street consequences of that event. Unemployment exploding, doubt about the validity of certain notions of government doing this or that. And when you get to uncertainty, that brings in emotion. And emotion often brings into doubt certain institutions, where people say, just clean the deck, let's start over, let's do something different. And I think we'll be at a tabula rasa situation at that point. And silver and gold will be the place, the perceived place to be. Golly, I wish I'd done that. You know what I mean? And base commodities as well. I think the noise effect, the panic effect could occur that quickly. So if silver does and gold accelerates from here, and even if gold just went to its normal full move, go to 8,000, people would be pulling their hair out. And yet it's done it before. What are you crazy about? Yeah, when you look at an arithmetic price chart and you run RSI or something, you think, oh my gosh, it's got to be. It hasn't even begun, especially if, one, you break the silver-gold spread out. Okay, that indicates silver is going vertical versus gold, and that always means silver is going up more than gold, not the other way around, going down less than gold. And also, if you break gold out above that very narrow S&P 5, we'll call it, then it's signaling a major asset class move just beginning. So it's not the end of something, it's the beginning of something. And people, I think, need to put this into the context when they're looking at the simple price chart of gold and thinking, my gosh, yeah, you're going to have downturns. Get used to them. The issue is, where was your point of entry? If you entered at proper places, you don't care. Yeah, you're going to suffer 10% hits here and there, but it's going to go away because you're not through. If you see the broader context. And everybody thinks every 10% drop is the end of it. No, it's not. This happened in the middle of, for example, the 79 to 80 move, or the 2010 to 11 phase in silver. There was a month in the middle of that 6-month process where you had a bad month. And you said, oh my gosh, that's a reversal, it's all over. It wasn't. Turned around and went right through it again. Okay? So if you're a late comer, yeah, you might get shin kicked. But again, if you were an investor at the appropriate places that MSA defined over the last 10 years, and said that don't get out, then take it. It's just part of the process.
The coming transition will not be gentle. A weakening stock market, rising unemployment, and a crisis of confidence in currency systems could push investors toward assets they can touch, metals and core commodities. Gold and silver are not near the end of a rally. They may be only beginning. Sharp corrections will occur, but long-term holders historically thrive through volatility. Many will say they missed it once prices are already soaring. This could be the moment where early positioning matters most. The world is entering a reset, and the winners will be those holding true stores of value.